Hello and welcome to Questioning the Manager. Today we are joined by David Smith, who is the fund manager for Henderson High Income. David, thank you for joining us. So if you could tell us a bit about the performance of the trust for the first 6 months.
Yeah, so it was, if I break it down to the two quarters, Q1 was quite tough for markets generally. You saw quite a big, sharp sell-off globally, and that really did impact the trust really, because we saw, you know, in times of market volatility, you expect defensive shares like tobacco, telcos and utilities to outperform those types of markets, and actually those were the sectors that actually underperform, which, you know, given they generally pay quite a high dividend yield, we've got exposure to those sectors, and actually that was quite painful to performance. Actually in Q2 we saw quite a strong rebound in both markets and actually in the NAV. So across Q2 the NAV was up actually 9.3%, outperforming our benchmark. So actually it was quite encouraging to see that rebound both in the NAV and the relative performance against that benchmark.
Now there seems to be a lot of pessimism towards the UK market at the moment, but are there any sort of sectors that give you reason to be optimistic?
Yeah, I mean, you know, sentiment is low on UK equities at the moment, on the UK market, and you know there are factors out there that justify that. You know, the political situation, Brexit situation, etc. But you have to put it in context of, you know, the UK market has now underperformed global indices for the last 5 years. Valuations are quite attractive in the UK. The dividend yield on the UK market is now a 15-year high relative to global indices. And actually, when you look at the certain surveys of global asset managers, you know, UK is very much the most underweight region across the globe there. So from that starting point, actually the UK market is looking quite attractive. Now within the UK market, let's not forget that 2/3 of the UK market, their earnings are derived overseas. So it is still a very global index. You know, you do see find good UK companies with good overseas exposure. One of them we like is Johnson Matthey, the specialty chemical company. It makes pollution control systems, so catalytic converters for the likes of cars, for the likes of industries, etc. You know, and this is a good business, well diversified, makes very strong returns, but yet it's trading at a significant discount to the global peer group. So kind of using that opportunity to own in what we think is a very good business on an attractive valuation for the long term. Now that's not to forget, let's not ignore some of those domestic companies. But you know, where we are focused on those domestic businesses, we're looking for the really good quality, strong businesses. You know, the likes of the Ted Bakers of this world, the likes of the Whitbread of this world, got strong brands, good market positionings, and good underlying growth going forward.
And have there been any additions to the portfolio of late?
Yeah, so one of the new additions to the portfolio was TI Fluid Systems, and it's a company that makes brake and fuel lines for the automotive industry. It's a good business, it's got high market shares, it's very global, so it's well diversified, and it makes critical systems for the industry. And that's kind of what we like: market leadership, specialised, very niche products, very high barriers to entry. It's also a business that has very good cash flow, you know, producing a 10% free cash flow yield, which we find very attractive essentially versus that global peer group as well. So good opportunity to own what we believe is a good business, growing at quite attractive rates.
One of the stocks that I'd like to talk about is Tesco, which has been in the news quite a lot recently, particularly in light of the Asda and Sainsbury's merger. What are your thoughts on the company and why do you own it?
Well, I think the company are doing all the right things. New management team they've been there for a couple of years now, and I think, as I said, they're doing the right things. They're cutting costs and they're improving operational efficiencies, but they're reinvesting those savings back into the business to make sure the food quality is there, to make sure the service quality there, but to make sure they're very price competitive. And I think that really is the key to get that volume growth coming through, which will really mean that their margin upside is going to be sustainable going forward. You know, anyone can really cut costs to get the margins up, but it's all about sustaining that upside to margins into the longer term. I think what the management team are doing is going to sustain that margin upside through the longer term. Now, despite them seeming to have that momentum coming forward, I think people are still very sceptical they can hit their long-term margin upside targets. Now, we believe they can, but even if they don't, they're still generating significant amounts of free cash flow. I think on the lower end of their margin target, they're still generating a 9% free cash flow yield, which really means actually their dividend, now they're starting to pay the dividend, we think that dividend can grow quite aggressively, certainly over the medium term. So, you know, the the shares have been good since we purchased it, but we think the momentum and the turnaround story has only just begun, and there's a much further upside to go from here.
David Smith, thank you for joining us.
Pleasure, thank you.